Good evening, ladies and gentlemen. Welcome to Q1FY22 Earnings Conference Call of Aegis Logistics Limited. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risk and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anish Chandria, Vice Chairman and Managing Director of Aegis Logistics Limited. Thank you, and over to you, sir.
Thank you. I'll be presenting the Q1 results for the current financial year FY22. It was a below par set of results for Q1, really affected by the peak second wave of COVID in April and May, especially on the gas business side. Fortunately, as I will explain, sales volumes are already picking up in Q2. That means from July onwards. But Q1, April, May, June, particularly April and May, were affected by the peak second wave of COVID. Let me go through the figures. Total revenues for Q1 were 678.1 crores versus 636.4 crores a year earlier. Total EBITDA for Q1 was 114 crores versus 118 crores a year earlier, a drop of 3% year on year. Normalized profit before tax for Q1 was 90.3 crores versus 92.2 crores a year earlier, after adjusting the earlier figure for the employee stock purchase plan of last year. So that's a drop of 2%. I just want to make it clear that from this year onwards, including Q1, the employee stock purchase plan, there is no more expensing for that. So that will fall out of the figures, but obviously to compare on a like-for-like basis, we have to adjust the previous year's quarterly figures for the non-cash charge of the employee stock purchase plan. Profit after tax for Q1 after all minority interests, that is net profit after tax available to Aegis shareholders, was 66.4 crores versus 71.8 crores, again after the earlier year, adjusting for the employee stock plan. So that's a drop of 7.5% year on year in net profit after tax after all minority interests. Let me go through the segment analysis as usual, which will explain what was happening in the underlying business segments, starting with the liquid terminal division, which remained strong in Q1 as it has throughout the COVID crisis. In fact, another record revenue figure for Q1, 66 crores for Q1 versus 55 crores a year earlier, a rise of 19% year on year in revenues. And EBITDA was also very strong, 49 crores for Q1 versus 40 crores a year earlier, a rise of 23% year on year in EBITDA for the liquid terminals division. Again, it shows the efforts of the past expansion in capacity, which we have carried out, paying off in increased revenues and increased EBITDA. And of course, the commissioning of the new capacity in Mangalore and in Haldia, which started to show results in Q1. Just to remind everyone that we had a project of 50,000 kiloliter expansion of capacity in Mangalore and 54,000 kiloliters in Haldia. So some of those revenues are already in Q1, and they will continue to be sustained throughout FY22, which will add to the liquid terminal division revenue growth and profits growth. So as I said, actually the liquid terminal division performed very healthily in Q1. But the gas division was affected again, just like last year at the same time, around this time, COVID. Of course, last year there was a national lockdown, this year in April and May, there was no national lockdown. Of course, there were various state curfews and state lockdowns and all that. But April and May, particularly when cases were rising to 400,000 a day in India, we were affected in all segments of the gas division, which I'll go through the volume figures in 1 minute. Let me just quickly finish the revenues and EBITDA figures for quarter one for the gas division. Revenues in quarter one was 612 crores versus 581 crores a year earlier. The EBITDA in quarter one for the gas division was 65 crores versus 78 crores a year earlier. So a drop of 16% in the EBITDA of the gas division. And as I said, the impact was felt in all the market segments that we have in the gas division. Let's start with the LPG throughput volumes. It was 568,000 metric tons of throughput volumes in our three terminals of Pipavav, Haldia, and Mumbai in quarter one versus 700,000 metric tons a year earlier, a drop of 19% year on year. And all terminals, Haldia, Mumbai, Pipavav throughput volumes did fall in the face of this second wave. Quite simply, there were less ships and less cargoes ordered from the public sector units in all three terminals, particularly in April and May. There was a bounce back in June as the COVID issues started to reduce, but April and May was definitely affected. In addition, there were two major cyclones which affected both Pipavav and Haldia ports in quarter one. Now, I would like to say that our terminals actually were not affected. There was no real damage in either Pipavav and Haldia in our terminals, but it was more the two ports. They sustained some damage, particularly in Pipavav, and the impact was really more in terms of reduction of shipping when those cyclones hit, because obviously no one could bring ships during those days. So that was the impact of the cyclone. But industrial sales, now the next segment, industrial sales in quarter one, which is part of our retail distribution segment, was 22,271 metric tons versus 7,414 metric tons. So that actually was a very big rise of 200% year on year, despite the COVID, which suggests that at least private industry, unlike last year when we had a national lockdown, private industry kept going in terms of their consumption of gas. So that was reasonably healthy. Auto gas, however, was 3,567 metric tons in quarter one versus 2,944 metric tons a year earlier. So still a rise of 21% year on year compared to last year's lockdown, but still much lower than quarter four figure, January, February, March of 2021, where we sold 5,926 metric tons. So 3,567 metric tons in quarter one of FY22 was lower quarter on quarter, but obviously still higher than the previous year. So there was impact of COVID on that. Clearly less movement of people, so less use of auto rickshaws and taxis. That obviously would affect the auto gas business, but not as much as when we had the national lockdown last year. Similarly, the cylinder business, the commercial and domestic market segment, sales in quarter one were 5,039 metric tons versus 2,553 metric tons. Again, 97% rise year on year, which was affected by the national lockdown last year, but still lower than the 6,430 metric tons in quarter four of FY21. So 5,039 metric tons in quarter one of this financial year, FY22, still lower quarter on quarter, but higher year on year. And sourcing was 100,000 metric tons in quarter one versus 158,000 metric tons a year earlier, the sourcing of gas. So the summary is, I think, primarily the COVID second wave did affect every market segment for LPG sales volumes compared to the previous quarter, quarter four. Some positive sales figures year on year, but obviously if we had not had the second wave in April and May, it would have been better. Let me talk about the outlook for quarter two and the rest of FY22. Now, we have some good expectations for the liquid division throughout the rest of the year, including in quarter two and the rest of the year, obviously because of the new capacity that we have commissioned in Mangalore, the 50,000 kiloliters, and the Haldia 54,000 kiloliters also. So that business, every terminal, whether it is Kochi, Mumbai, Haldia, Mangalore, etc., Kandla, they're all operating well. Pipavav liquid remains the only one which is still below expectations in terms of capacity utilization, but all the other terminals have been strong throughout COVID, and they remain strong in Q1 of FY22, and we expect that to be sustained throughout the year. So that's positive. Now, for LPG volumes, gas volumes, for auto gas, we're already seeing signs of a bounce back in quarter two. Obviously, July is almost over, so we're actually seeing a good bounce back in auto gas. It started already in June. That is the tail end of quarter one, but it is risen already, the sales volumes in July, and we expect further increases in sales volumes in August and September, assuming that there is no third wave of COVID, which I don't know if there will be, but right now things are definitely better than April and May. So at the moment, the expectation of our marketing team is continued volumes growth, sales volumes growth of auto gas. In fact, we are now hoping to see a recovery to pre-COVID sales levels in the second half of this financial year, that is in second half of FY22 from October onwards. So some bounce back already seen in quarter two, July, August, September, but we're actually now looking for the first time in 18 months for growth beyond COVID sales levels. In other words, going back to pre-COVID sales level times in terms of auto gas. Again, assuming that there are not so many COVID restrictions and people begin to move around as they were. Similarly, for the cylinder segment, again, we are seeing a recovery in quarter two in sales volumes in July from the quarter one levels, again due to less impact from COVID. There are more use of LPG in hotels, restaurants, etc. So there is going to be a positive bounce back in quarter two, it looks like. July, we're already seeing that, and we expect there to be further growth in sales throughout FY22 as a result of not only less restrictions because of COVID, but also because we have expanded the dealer distribution network throughout this last 12 to 16, 17 months. And finally, for the LPG logistics throughput volumes, the throughput volumes in Haldia, Mumbai, and Pipavav, again in quarter two, just like the other ones, the other segments, we're seeing a bounce back in sales volumes from the quarter one figures, which is heartening to see. Obviously, that is July figures, but the expectation in terms of the order book for August and September in terms of what we expect is positive, and we're expecting to see better volumes in quarter two, and further increase in volumes in the second half of FY22 due to the following factors. One, there's normally a better seasonal demand from quarter three onwards, which is Diwali time, etc. That's normally the case. We also expect to see more rail throughput in Pipavav once the jetty modification work is over by Gujarat Pipavav Port Limited to allow partly laden VLGCs. So we expect that to kick in the second half of the financial year with BPCL rail throughput particularly increasing as well as IOC, because if they're able to bring VLGCs into Pipavav port, that'll make a big difference to the rail throughput volumes in Pipavav compared to what we are seeing today. And of course, the commissioning of the Kandla LPG terminal in the second half of the financial year FY22. Which brings me to the projects update, and of course, just a reference to the Vopak deal, which we announced a couple of weeks ago. First, let me start with the Kandla LPG project. The project work is getting back on track after the hiatus of quarter one. You recall in the last earnings call I said in quarter one we did have a problem with manpower during the peak COVID levels of April and May. There was actually difficulty in many of the contractors in terms of manpower, and also the lack of oxygen, which affected the construction work. So work did slow down on the project, but I'm pleased to say that now those factors have dissipated, and we are mobilizing as we speak the contractors, the manpower for the final push to complete this project, and we hope to see the commissioning in quarter three of this year, FY22. That means mechanical completion of all work by end of quarter two, and then the commissioning in quarter three. And that should be positive for throughput volumes for the Kandla LPG in the second half of the year. We've also announced a major deal with Vopak, which I referred to, and now we're going through the conditions, all the conditions precedent and the various milestones for closing, which we expect in the next 6 to 8 months to close that deal. And I think really nothing else to say on that. We've explained the deal. But even before we close the deal with Vopak, Aegis is already not waiting around. We're starting to execute the joint business plan of expansion in our terminals business. So nothing to say today, but we will be obviously as and when we can implement the various projects, etc., in that joint business plan with Vopak. We will not wait for the closing, but we will start implementing that in this year, FY22 itself, and then of course beyond that in FY23 once the joint venture starts, which I remind everyone, 51% of the earnings for the joint venture will be consolidated into Aegis earnings. 49% will be Vopak, but 51% of the earnings of the joint venture Aegis Vopak Terminals Limited, most likely from next year. But FY22 will remain Aegis business while we close the deal. Okay, that really closes my presentation. You can now take some questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question at this time, please press star 1 on your phone. We have the first question from the line of Dipesh from Equirus. Please go ahead.
Yeah, hi sir. Thanks for taking my questions. Sir, throughput volumes growth has been lagging the Indian LPG imports for the last 6 quarters now, and this quarter your market share seems around 16% of the overall LPG imports, which is the lowest in the last 3-4 years. So just wanted to understand what are the reasons for the same that you're underperforming in this thing.
Yeah, I mean, I think that's correct what you said. I think there are specific factors, but all terminals, whether it is Haldia, Pipavav, as well as Mumbai, we did see, as I said, in quarter one, less ships and less cargoes. But I think it is temporary because we, as I said, we already see in quarter two a healthy bounce back starting in July, and so there's no particular factors. It's just that, ultimately depends on the public sectors, which means IOC, HPCL, BPCL, where they want to import the cargoes, which terminals, etc. But there was no, I don't think there's any particular concerns, but because we're already seeing a good bounce back. So let me go through very quickly. Haldia, without going to specific numbers, we now know, of course, BPCL has already gone out to their own terminal, which was the case since December of 2020. But we are seeing rising volumes from HPCL, which is the anchor customer in Haldia, in quarter two, a bounce back from quarter one. And they have indicated to us that throughout the year there will be growth, and so we have a good good forecast from HPCL in terms of volumes. It will not replace all the volumes of BPCL that immediately, but we are already seeing a bounce back in volumes from quarter one, as well as replacing some of the loss of the BPCL sales. And that, of course, we expected, and we will continue to see, we think, in FY23 and beyond, further growth from HPCL. But this year, so Haldia, I think, is looking. Mumbai has already bounced back very strongly in quarter two. In fact, in June it already started bouncing back. So not April, May, but in June itself. But July is seeing further growth. So Mumbai is looking very strong, using that Uran-Chakan pipeline and etc. So we remain confident in Mumbai that that's good. And Pipavav, as I said, I think the railway movement is going quite well. With signed up two customers, IOC and BPCL. But BPCL is facing challenges right now in doing more throughput that they want to do, because they've indicated they want to do because of the lack of ships. So there are specific factors on the jetty, which is why we have been working with the port to make those modifications. Of course, it's their project in the jetty, which I mentioned. Once that is over, and we have a clear timeline from Pipavav Port as to when that jetty modification work will be over, then we will be able to handle partly laden VLGCs in Pipavav for BPCL, IOC, etc. And this sheer number of ships can then increase, and therefore the throughput volumes in the second half of this financial year. So I think there are some specific factors in Pipavav which will now change, probably in the second half of the year. But Mumbai is looking strong, and Haldia is now looking strong as well. So I think don't see any concerns. And then, of course, once we commission the Kandla LPG project, that will give a big boost to the volume. So we do expect, just to complete the picture, we do expect to see a good volumes growth in our LPG division in FY22. But there are some specific challenges that we had to deal with in April and maybe because of COVID. But we don't expect any major problems in terms of volumes growth, taking all the factors into account. So after being affected by COVID and etc., but I don't think that will really be. Of course, I can't predict COVID, but I don't expect that to badly affect the throughput volumes in the year as a whole now. But we're already seeing the first signs of a bounce back in June and July, and we expect that to continue in all the time.
Got it, sir. So secondly, given the delay in the Kandla terminal, what is the expectation for volumes in FY22? Because the PPT still mentions 1 million tons. So I just wanted the updated number now.
Yeah, I think we are obviously 1 quarter delayed from earlier we thought we would be able to commission in quarter 2. Now it will most likely be quarter 3. So I think pro rata we probably would we've been budgeting around 700,000 tons. So pro rata probably will be 1 quarter less than that if you just look at it. So because it will really be Q3 and Q4 rather than Q2, Q3, Q4. So that's what we see. But I think I will be able to have a better sense once we actually commission the terminal, because it really depends on the customers how soon they really want to get going. If once that that terminal is ready. So ask me again in the October earnings call, and I probably have a better sense. But for now, I would probably just by taking out one quarter, because we are delayed by one quarter, quarter two, I'll probably adjust downwards at this stage. But we might be able to have more clarity by October.
Sure, sir. So lastly, the EBITDA per ton for gas handling that you normally mention around 1,000 rupees per ton, that seems to be lower this quarter. Is it a correct observation? And secondly, the LPG prices have moved up 30% YOY. So what kind of EBITDA per ton are we making in the distribution business?
So on the I don't really recognize that because the EBITDA figures on the throughput, that seems to be stable because all the rates are the same. So don't know where you get that, but so I think that has remained stable. All the rates are the same, so they haven't changed. As far as the on the distribution business, yes, international LPG prices have increased. Not as much as crude oil has increased. In fact, we were discussing in the Aegis board meeting yesterday the same issue. But the distribution margins have actually remained quite stable and quite good. That's the nature of the business. But what was affected was the sales volumes, not the margins. But the margins have remained quite stable throughout.
Okay. Thank you, sir. Thank you, and all the best.
Thank you. A reminder to the participants, anyone who wishes to ask a question at this time may press star and 1 on your phone. The next question is from the line of Rajat Sethia from iThought Financial. Please go ahead.
Hi, thanks for the opportunity. Sir, there are a lot of discrepancies between the press release related to the deal that Vopak has come out with and what we have heard from you. Could you please clarify on the same?
Yeah, we have actually, in several calls, we have actually explained exactly how it adds up. I'm going to ask our CFO, Murad Moghadina, to explain again. You might not have been on those calls, but it all ties up very well. Murad, do you want to give the usual accounting of the Vopak amount in euros and the rupee amounts that we have given, like you have given?
Yeah. To very simply put it, and we have explained several times in past calls, that the Vopak press release talks of three numbers, 153, 115 and 40. If you add all the three and convert into rupees, that is what we have said is what we are going to receive out of the deal, 2,766 crores. So it matches.
So then the follow-up is that this 153 that you are talking about, actually as per that release, it says Vopak and Aegis have arranged this financing.
Yeah, but that is going to come entirely to Aegis for the JV transaction.
No. So it will come to Aegis. That is understandable. However, is this debt going to be on the books of JV?
On the JV co, yes. So what both the partners have decided is going forward, JV co from day one would be conservatively geared to a maximum debt gearing ratio of 0.5 to 0.6. So this debt is going to remain over the lifetime of the JV co, and that is why the clarification given by Vopak.
Well, just to make sure that I have understood it right. So we are saying we will take 153 million euros of debt in JV, and then that 153 million will come to Aegis as part of the consideration, right?
Right. Yeah.
So that essentially does not convert into. So basically, we are raising debt in the JV and then paying ourselves. So essentially, the effective valuation of the JV of the deal, in fact, goes down. Is that understanding correct?
No, that your understanding is wrong. The whole consideration amount is 2,766 crore, which Aegis is going to receive. And you see, the conduct of JVCO from day one is what has been decided, how the capital structure is going to be formed. So that is how it will conduct itself. So whether you take it out of projects which the JVCo do or for this, so debt and equity has been pre-decided between the partners, and that is how it is going to function. So that has got nothing to do with what amount we are going to receive. So what we are going to receive out of the transaction is 2,766 crore. The RECO which you asked for is what we have clarified to you.
Sir, I understand. What I am saying is that, so other way of saying, looking at this would be, the JV partner is going to give only, the payment from their side is going to be whatever, like 2,700 crore minus 153 million euros, right? Because 153 million euros essentially is coming from the JV as debt, correct?
Yes, yeah, you can say that, but it's not that simple. So I've explained to you what was there to
sorry to interrupt you, sir. Sorry to interrupt you. So in other ways, can we also say that 153 million, since we are gonna own 51% of it, so 153 million का 51% तो debt हम ही ले रहे हैं अपनी books पे, and then we are paying ourselves as cash, correct?
Again, you are looking at it in a different way. I have said it very simply that how the JVCo structure, capital structure is going to be conducted, that has been explained. So that debt is ever going to remain. So there is no payback of that debt, because that is how it will be geared. So there is no outflow of that debt. That is how the capital structure of that JVCo has been structured.
Yeah.
So what you are trying to say is not actually that what is going to happen.
Yeah. So can
I put it in my way just to close this conversation? So the way we have structured this deal, okay, and it's quite explicit, is that yes, there will be certain amounts of by Vopak to Aegis, which are the figures that you quoted in euros, which are for buying equity shares in the 49% of the joint venture company. That is absolutely correct. And then there are these payments after 3 years of an additional up to 40 million euro paid by Vopak to Aegis. So that's clear. And then when we negotiated the whole thing, the deal and the structuring, we had, as far as Aegis is concerned, we had a certain target cash amount that we wanted to take out of the transaction. And obviously, it was then a question of, okay, what is and this was discussed explicitly with Vopak over a few months. What is an appropriate capital structure, as Murad rightly said, for the venture company? That's the next part of the discussion. And clearly, zero debt was not acceptable to us or to Vopak, because why would you have all this assets and infrastructure with zero debt? That's not an appropriate capital structure. So we ended up negotiating. We said, look, we have certain conservative gearing ratios. They had certain ratios. Anyway, finally we compromised and we said, okay, 0.5 to 1, debt equity ratio of 0.6 to 1, 0.5 or 0.6 to 1. That's the maximum. And with all the assets that we have, therefore that translated into this much debt in the JVCo, which, as Murad said, because the JVCo is throwing off a certain amount of cash, we expect that to be maintained almost on a perpetual basis. That is a reasonable debt equity structure. And then we said, okay, then that amount of debt, that bank debt, let's say, that we raised in the JVCo, which both parties, Aegis and Vopak, will be working to arrange. In fact, that work is already going on right now. That we will be taking into Aegis as part of the transaction. So we will be extracting that additional cash, hence the 2,766 crores. So that's the way the deal was negotiated. We wanted a certain amount of cash to be taken out of Aegis, and this is the way we structured it. Why did we want a certain amount of cash? Because this allows Aegis in its own balance sheet to have that cash in order to be able to reinvest as required. Vopak will also be able to, investing in the JV Co because they have a large capex program of up to 4,500 crores, the JV Co. So both shareholders, Aegis as well as Vopak, from time to time will be required to fund that capex thing. But we wanted to keep the cash in Aegis rather than just let it sit in the JV Co. And that's the way we structure it. Plus, it also gives Aegis the flexibility. So when we are discussing with Vopak other big ticket projects, then we have the financial firepower with that 2,766 crores to be able to put our share of the money up. Let me remind all listeners that we've never had the ability at Aegis to have this size of balance sheet or financial firepower to be able to actually deploy into those projects. But we now will. So I think it gives us a very strong balance sheet in Aegis Logistics Limited and gives us the ability to not only fund our share of the 4,500 crores of capex that the joint venture company will need to do as required, but it will also allow Aegis to take advantage of future projects that we will do jointly with Vopak. And that's what it's all about ultimately. This whole deal and why we did it with Vopak, by the way, was not to generate cash, but it was all to say, okay, how can we actually, together with the world's largest tank storage company, how can we jointly do more projects, faster projects, using and actually have the financial strength to be able to invest in those projects, which will give future profitability to Aegis shareholders. I mean that's really the basis. So I hope that clarifies. I think we've been through this several times even in previous calls, but the numbers add up, and that's the way we structured it, so that we would actually extract this amount of cash to up to 2,766 crores in Aegis as a result of this transaction.
Understood, Anish. So basically, for any future capex in the JV, JV would be raising more debt because this debt will essentially be going towards the deal consideration to Aegis, correct?
That's right, and of course, exactly. And as I said, for the future capex, we can, depending on making sure that we don't go above that 0.5 to 1 debt equity ratio. If we can raise more debt in the JV Co, as long as we remain within that limit to fund that further capex, we will. Of course, the JV Co will be throwing out its own free cash flows, which will also go towards that capex. But then there is the two shareholders, Aegis and Vopak, are ready to put in further, and will have to put in further amounts. We'll see whether it will be in the form of equity, of shareholder loans, whatever it is, or preferred stock, whatever it is. But both shareholders will make sure that the JV Co can fund its capex program of up to 4,500, and we fully expect to recycle some of that 2,766 crores into the JV Co, and Vopak will do its share, 49% pro rata.
Understood. Thanks. Thank you so much.
Thank you. A reminder to the participants, if you have a question, you may press star and 1 on your phone. The next question is from the line of Rajesh Kothari from Alpha Accurate Advisors. Please go ahead. Rajesh, sir, we are unable to hear you. Mr. Kothari, we are unable to hear you. As no response, we move to the next question from the line of Sriram Rajaram from Ratnatraya Capital. Please go ahead.
Yeah, I just have one question from my end. This is regarding the minority share of EBITDA. Suppose Vopak deal, what would be the percentage of assets that would be taken out in terms of minority? If you can give some broad range in terms of EBITDA that we use.
Yes, again, we've answered this question on several other calls, but you're not on the call. So I'll ask Murad because he has all the figures there with him. Murad, do you want to just answer that question about what share of EBITDA will go out into the joint venture company
Yes. As per the estimates of FY22, we estimate around 90 crore of EBITDA to go to Vopak from this deal, from the businesses which are being put into the JVCO.
Okay. Building an operation of a logistics infrastructure dedicated for them in their complex. So it's almost like a terminal within their complex. And those are large ticket sizes, 500,000 to 1 million kiloliters. The whole of Aegis today is, in terms of liquid terminal capacity, I think the current figure is over 800,000 kiloliters. So just what, and we are talking about in this up to 4,500 crores, doing at least, doing a couple of those industrial terminals. And so those are not just pulled out from the air. These are deals that Vopak has been working on as far as India is concerned, and with particular multinational clients of theirs. And of course, we have to see whether those deals happen or not. But they think that they could, and hence there's a range of 2,500 crores to 4,500 crores. So I hope that shows you that this joint venture with Vopak enables Aegis to do projects of a different size and do types of projects that we've not done before, including the VLGC jetties, including the industrial liquid terminals, as well as bigger size LPG projects that we have not been able to do in the past. And that's the benefit of Aegis and Vopak working together. All of which, if they're highly profitable, will result in greater profits for Aegis, ultimately 51% of it in Aegis, in a condensed time frame of 5 years rather than taking 10, 15 years. And what I've said in the last couple of weeks is, look, never in the history of Aegis have we seen that type of capex program of 2,500 to 4,500 crores over a period of 5 years. And, we talk in hundreds of crores, over 2 years. So, the reason we can do that is we're going to do it together with Vopak. And that will ultimately result in profits growth for earnings per share for Aegis shareholders.
Sure, so that is very helpful.
Can I just add one comment here, which answers part of the question that Ankit had?
Sure.
Yeah.
Raj, go ahead. Raj.
Yes.
Yeah, go ahead.
Sorry, there was another part of your question, I believe, the earlier part, which is other than the joint venture growth opportunities, which you alluded to, in the deployment of that cash. Your question was also that as far as Aegis shareholders are concerned, what would they see that? Because Aegis, as a standalone entity, will also have substantial cash inflows on an ongoing basis from its retained businesses, and of course it will be sitting on a fairly healthy cash balance as well. And I think your question was, first part of your question was, what about Aegis shareholders directly? And I think two things I would add to what Anish has just commented. Obviously, Aegis is going to be focused on expanding its retained businesses, the retail LPG business, and any other opportunities which come up. So we'll definitely be looking at that. And the second point is that the Aegis board has, in terms of capital return policy to shareholders, already has a fairly established dividend policy, and we intend to continue growing our dividend every line with what is reasonable and in line with the profits growth of the company. So, the Aegis shareholders will definitely not be forgotten. But our objective is obviously to continue to deploy capital in profitable and where there's high return on invested capital projects.
And can I just add? Sorry, Raj, that I remember the first part of the question. Can I just add to what Raj said? Absolutely right, which is that we think now at Aegis with the Vopak deal, but also the business that Aegis retains 100%, which is the retail LPG business, as well as Mumbai terminals, particularly the LPG terminal. We think that there is also growth, a lot of growth there. And in other words, Aegis, through its joint venture with Vopak, as well as its existing business, 100% owned businesses, there are enough projects and profitable opportunities and acquisitions out there to deploy into that, which will be rewarding to shareholders rather than just return capital to shareholders in the form of buybacks or dividends. That is absolutely our policy, that we think there are great profitable opportunities out there which we can get high returns. If the day when we have run out of things to invest in and grow, then yes, then the question may come, okay, let's have higher dividends and Aegis will stop being such a growth company. But that day has not come yet, and we're nowhere near that thing. The whole point of the Vopak deal was actually to enhance the scope of profitable growth opportunities, and we believe that we've been able to kind of at least show people the direction which we're going to go. And and I think ultimately that's good for all Aegis investors and shareholders, to see that the company can actually deploy capital into high growth and highly profitable opportunities. But we're nowhere near running out of that for many years to come, and I think that's what at least people would like to hear, that Aegis is actually putting its foot on the growth pedal rather than taking it off the growth pedal.
Fine. The kind of projects that we have, that you alluded to, large storage tanks or for petrochemical companies. Do you think with this kind of capital you might also be able to, and the technical expertise of Vopak, you might also be able to reduce the construction timelines and getting approval? So let's say such a large project, and normally we have seen for our previous projects, we usually take at least 2 years to construct and getting approvals and all. So the timeline for construction of these projects, can that also be reduced with Volpak's expertise?
I don't think so, because Aegis has that's Aegis expertise, and we've proven that we are amazingly fast in terms of how we execute these projects under Indian conditions, as well as in terms of the costing of these projects. In fact, one of the things that attracted Vopak to Aegis, apart from having the network of assets that we already do, is its project execution capability, because it's recognized by Vopak that this is really, quite frankly, excellent performance. So that's the strength that Aegis brings to the table. I don't think that that's something that will be able to tremendously improve, because it's already at a very high level. But what will help is with Vopak is the sheer number of projects that might be going on simultaneously throughout the country, in different parts of the country. We will need more project strength. We will need more people. And the good news is, as I said, Vopak Projects Department is already helping out. So we'll just have more people to be able to do multiple projects, and we don't have to just do 1 or 2 projects at one time. We can do multiple projects, and the faster we can do multiple projects and deliver them on the ground, the faster it translates into profits, which is what we're all interested in. So I think that's the benefit of Vopak, but not really increasing the speed of everything. Murad, do you want to just comment on that, because you're very much involved with the projects team as well?
Yeah, you're right. You're right that Aegis has been the best in the business of execution of projects, and as far as Vopak is concerned, I think yes, they will give us technical expertise on projects, which will help us maybe like we have said, to get into new products, as well as to improve if there is any room to do so in whatever we have been doing in past years.
Yeah. Thank you so much. That was very helpful.
Thank you. The next question is from the line of Himanshu Yadav from Edelweiss. Please go ahead.
Yeah, hi.
Absolute amount is 90 crores.
That's the estimate from FY22 projections. Yeah.
Sure, that's very helpful. Thank you.
Thank you. The next question is from the line of Jaiveer Parekh from Sunidhi Securities and Finance. Please go ahead.
Thanks. My question has already been answered.
Thank you. The next question is from the line of Ankit from Bamboo Capital. Please go ahead.
Yeah, thanks for the opportunity. So, if you look at it, we'll be getting close to 2,500 crore plus from this post completion of this deal from the JV as well as from Volpac. And if we talk about the JV, we have capex plans of, let's say, around the ballpark figure that you gave in the last call was around 2,500 to 4,000 crore to be spent over the next 3 to 5 years. And even if we assume there is a 1:1 debt equity requirement in JV for funding this project, it will not be that significant to deploy the entire 2,500 crores we will be receiving. And apart from that, over the next 3 to 5 years, we'll be generating Aegis standalone will be generating cash flows, and even the JV will be generating significant cash flows. So, any thoughts on, returning this capital to minority to the shareholders, and how do we plan to deploy such a huge cash that we have on a standalone basis? I know it's still early days for you to decide, but if you can broadly throw some light on whether giving money back to the shareholders will make more sense than deploying this money in future projects.
Yeah, I'll answer that directly. First of all, let me just clarify one thing which I think you got it wrong. Remember, we said very clearly that the debt equity ratio of the JV company there's a cap of 0.5 to 0.6 to 1, not 1 to 1.
Okay.
So we will not be taking more to fund the 4,500 crores of capex if we go above that thing. Therefore, there will be a requirement of both shareholders, Aegis and Volpac, to recycle for Aegis to recycle some of that cash amount into that 4,500 crores of capex, up to 4,500 crores of capex, because we will not go above the debt equity cap of 0.5 to 1. That's the first thing. Second thing is, yes, you're right. There will be a certain amount of free cash flow from operations thrown off by the JV Co. Of course, we will be seeing. The board will decide. Aegis Volpac board will decide whether some will go into dividends, and bulk of it, yes, will be going into the debt service of that debt that we're going to take, that we talked about in the JV Co. So there will be some of that, and some will go into the capex, that 4,500 crores. So that's the balance that we will have to judge. But there's no question in our mind that both Aegis and Volpac will have to pump in further funds into the joint venture company in order that we do the project. Now let me be very clear on this. The whole point of this deal with Volpac is to actually implement those projects as fast as possible, as long as they are commercially viable and high return projects. The whole what you would all like to hear as Aegis shareholders, presumably like me, is that that we can accelerate the growth and therefore the profits ultimately projects get commissioned, as long as they're regarded high profitability projects, which they are. And so we want to make sure that both Aegis, of course, Volpac we can say for itself, and the joint venture company itself can fully fund at on demand, actually, when those projects happen. We don't want to be scrabbling around for months on end saying, oh, how are we going to fund those projects? So as soon as we can do those projects, finance will not be a constraint from either Aegis, Vopak, or the JV company, because the whole goal is as soon as we can physically do it on the ground, implement those projects. One constraint will not be there in terms of finance. Management constraints will probably not be there in the sense that now we will have the bench strength of Vopak Global to help us, including, and by the way, even before the deal is closed, I can say this, the Vopak projects team have already been in touch with the Aegis projects team, looking at some of those projects that we have to start working. So even though the financial transaction is not closed yet, the work is already started between Aegis and Vopak. So ultimately, it's all about delivery and execution on the ground. That's what is going to result in extra profits for Vopak as well as Aegis, 51%, and doing it as fast as possible. And that's how the whole deal has been structured. So I hope that explains the thing. But the clear thing is debt cap of 0.5 to 1 in the joint venture company, that we will be conservative. Both shareholders have written that into the joint venture shareholders agreement, that we will not go above that cap. But therefore, both shareholders are prepared, Aegis and Vopak, to fund as required those capex plans, not only for the next 5 years, but beyond. But of course, the next 5 years is the most clearly defined.
तुम्ही ज्या व्यक्तीशी बोलत आहात त्याने तुमच्या कॉलला होल्डवर ठेवला आहे. कृपया लाईनवरच राहा.
Hello. So the second question on this, deployment on this 4,500 crore capex plan that we have in the JV. If you look at it, sir, Kangla has been our largest terminal, and that did not consume hardly 400 crore of capital. So just I know it's still early days, but such huge deployment of capital, even for setting new terminals, will not be needing such huge capital. So any broad, color on what kind of capex spend we will be doing in the JV that will require such huge capital over the next 3 to 5 years?
Yeah, sure. Actually, the whole clue is this, that we will be doing bigger size projects than what Aegis was doing in the past, but we'll be also doing different types of projects, not just LPG terminals or liquid terminals of the size that Aegis has been doing. So you're absolutely right. If you look at a Kandla LPG project, the capex was 350 crores. If you look at a Mangalore liquid terminal project, 50,000 kiloliters, the ticket sizes were much smaller. That's what Aegis could do. But now that we have tied up with Vopak, what we've jointly agreed over 8-9 months of discussion is that now we can actually jointly do much bigger size LPG terminals, other types of projects, and multiple projects, including connectivity projects like railway gantries, all at the same time. But we will also, you asked for a flavor, we'll also be doing, I just give you an example, things which Aegis has not been doing in the past. For example, and this is in our presentation of the deal, you can look at that on the website. The two partners, Aegis and Vopak, will be looking to invest in jetty construction. That's not anything that Aegis has ever done in the past with all those type of costs. And why are we doing that? It's so that we can actually have more, for example, LPG throughput to allow VLGCs to come in. This is going to be important. That's a constraint that we have to increase the throughput volume. So we'll be investing in perhaps one or two. Already those projects have been identified. Let's see whether they're one or two. But one is almost certain. The other types of projects that Aegis has not done, which is now going to be in the scope of the Aegis Vopak joint venture, will be what Vopak calls industrial terminals, industrial liquid terminals. And what this is something that Vopak does in other countries in the world, but they would like to introduce into India, that they build something like 500,000 to 1 million kiloliters or cubic meters of storage dedicated to a large multinational customer that they have. Let's, for the sake of example, let's call it a petrochemicals customer who basically outsources to the Aegis Vopak joint venture the whole.
Thanks for the opportunity. Two questions. One is, Manish, do you think FY23 the throughput volumes will be able to cross 5 million ton? And second, clarification from Murad. I mean, you said for FY22 estimated EBITDA share to Vopak is around 90 crore. I mean, how have you arrived at that? Because in the deal call you said 248 crore is the EBITDA, which is for the assets which are kind of going into the JV. So I mean, how this 90 crore maths works out?
Yeah, okay. Let me take the first one. I'll ask Murad to answer the second one. On the first one, obviously, I'm not going to give targets for FY23 in terms of LPG throughput volumes in this call or publicly. We don't do that. We give very specific forecasts of that. But listen, let me put it this way. If you go to our slide, just 1 minute, let me see where that is, which is the throughput capacity slide, slide 12. We are, once the Kandla terminal is ready, we will have a capacity of able to handle 9.6 million tons of LPG. And last year, we did an actual throughput of below 3 million tons. I think, I can't remember the figure, it was 2.9 or 2.8 million tons, something like that. So the whole goal will be to drive towards first the full capacity utilization of 9.6 million tons. I'm not going to give, as I said, the forecast of FY23, but it's going to depend on how much throughput we can do full year of operation in Kandla in FY23. It's obviously going to continue to depend on the Pipavav railway throughput and all those issues, Haldia the increase. So what I'm saying is that the whole game plan is how to increase from 3 million or 2.9 million, 2.8 million last year towards that full capacity utilization. It's going to take some time. There are specific things that we need to do there's specific things we need to do in Haldia. There's specific things we need to do in Pipavav, further things we need to do, which actually is part of the plan with Vopak. But the faster we implement those things, which is in the business plan, some of them are connectivity issues, the faster we can get those throughput volumes. And the way I would best describe it is we want to make all the terminals of Aegis and Aegis Vopak, the LPG terminals, the most preferred terminals to be used by IOC, HPCL, BPCL as the main users of these terminals. And the way to do that, we know exactly what we have to do. Basically, it's to make sure that they have the lowest delivered cost of LPG. But there are still things we need to do in order to get to that stage. So I think that's what we're about, and I think you will see over the coming years, I don't want to just say FY23, you will see rising figures of throughput volumes. Not because I say so, because Aegis is a nice company and Vopak is a nice company, but because the users, the customers realize that this is the most efficient way and the cheapest way of delivering LPG to where they want it. In other words, their bottling plants. And there's a whole host of things we need to do, some which are already underway, some of which will be implemented over the next year. Now, for example, Kandla LPG, just last point. The work that we're doing right now is to ensure the pipeline connectivity into the Loni pipeline, for example. That work is going on, so that we do give the customers that lowest delivered cost to where they want it. So things like that. These are all the things that we are building into our terminals. Just building a terminal is not sufficient. We have to do various things to make sure that they become the most competitive LPG terminals in India. Not there yet, but that project work is going on, and with the help of VOPAC, we'll be doing even better as far as all those things are concerned. So I don't want to be tied into a forecast for FY23, but what I would like to say is that the whole goal now of not only the joint venture Aegis VOPAC, but of Aegis itself is to, having built this capacity, and we're going to be building more capacity, LPG capacity, is to drive up those throughput volumes, which ultimately result in higher profits for Aegis and VOPAC and together. That's really the whole goal. The second question, in terms of the EBITDAs and all that, I'll hand it back to Murad to explain again one more time.
Yeah, we have explained this in our last video, and I'll again repeat. 248 is the total EBITDA of the business in this joint venture. However, large part of it is Haldia LPG business, in which VOPAC is taking only 24% stake. So as such, if you then accordingly calculate, it is 90 crore EBITDA, which is going VOPAC's way.
Sure, understood. Yeah, thanks. So, Anish, thanks for your explanation. Another way of putting my question is, I mean, how reasonable do you think is our estimate of having 1 million ton run rate in the first year of operation for Kandla?
If you look at it on a first year of operation rather than quarter by quarter, I think we still are comfortable with a range of 0.7 to 1 million tons. I think we're on a without looking at quarter by quarter, but on an annualized basis. So I think we are comfortable with that. As I said, the most important thing is to complete the project as fast as possible and to make sure that pipeline interconnection is there. That is absolutely to the Loni pipeline, because then it almost becomes. Let me be careful not to say no-brainer, but it becomes a very extremely competitive way of delivering LPG to where the customers want it. That's the conversation that we've had with the customers. So that's why we're comfortable with that 0.7 to 1 million tons as the first full year of operation. We do that, but the project is not over. We are still completing that work as we speak, but we are confident that we will be able to hit that budget that we said. 0.7 to 1 million tons the first full year of operations of Kandla. And by the way, that's also in the business plan of the new Aegis VOPAC joint venture company in terms of the budgets and financial plans. So VOPAC has also, should we say, endorsed that figure.
Sure, Ramdan. Thanks.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. I would now like to hand the conference over to Mr. Anish Chandria for his closing comments.
Actually, this time maybe I'd prefer Raj. He can summarize. I think I've said all my piece. Raj, if you could just summarize what we talked about as far as FY22 and beyond, that would be probably quite useful for everyone.
Yeah, certainly. So I think obviously we're not particularly happy with the Q1 of this year. Anish explained in detail some of the reasons behind the lackluster performance, but we are definitely seeing signs of a bounce back and return to more normal business conditions, and getting on that basis, getting our strategy back on track. Obviously, the announcement of our strategic partnership and joint venture with VOPAC is going to have a significant and major impact on every quarter and every year going forward, given the plans that we have and the capacity and capability, both from a financial and managerial perspective, to capitalize on the opportunities of India back on its feet. These opportunities and the growth plans obviously will not materialize every quarter in strict cadence, but there is a clear plan. And I think I'd like to convey to all our investors that we are extremely positive and confident on the outlook for the company, despite some setbacks that I think most companies have had in recent months. But we are very confident as far as the future goes. So I think that's it from my side. Thank you.
Thank you very much, members of the management. Ladies and gentlemen, on behalf of Aegis Logistics Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines.